Ubiquiti has dropped almost 50% in just 3 months. Usually a crash that steep means the business is broken, but here's the twist. The fundamentals still look remarkably strong. So the big question, has the market overreacted or are investors missing something? Let's find out. My first question is always simple. Can competitors disrupt this business over the next decade? For Ubiquiti, I think the answer is probably no, and here's why I would classify the company as having a narrow economic moat. Its biggest advantage is the UniFi ecosystem. Customers don't just buy a single Wi-Fi access point, they build entire networks around UniFi. Switches, cameras, door access and cloud software. Once locked in, switching to a competitor is costly and disruptive. Its second edge is a unique business model. Unlike Cisco or Fortinet, Ubiquiti has virtually no direct sales force, relying instead on distributors, online communities, and IT pros. This slashes operating costs, powering industry-leading profitability. That doesn't make Ubiquiti untouchable. Cisco, Fortinet, and HPE Aruba compete aggressively, with decades of experience keeping Ubiquiti from wide moat territory. But it has built a durable edge that many investors underestimate. Every chart and every financial metric in this video comes from Fiscal AI. I use this platform for every stock analysis on this channel. I dropped the link in the description and pinned comment below for 15% off. Here's the number that immediately stood out to me. Ubiquiti generates a return on invested capital of 71.6%. That's exceptional. For context, Fortinet generates 21.5%, while Cisco sits at 11.3%. Ubiquiti operates on a completely different level. Return on invested capital is one of my favorite metrics because it's hard to fake. It proves how efficiently management turns capital into profit. Returns this high signal pricing power, strong economics, and disciplined capital allocation. Their return on equity looks even wilder at 186.5%. But that number is misleading here. Ubiquiti's small equity base distorts return on equity, making it less useful for comparison. That's why I weigh return on invested capital much more heavily. And on that metric, Ubiquiti is one of the most profitable networking companies on earth. High returns on capital only matter if a company can keep growing. Fortunately, Ubiquiti has done just that. Over the past decade, revenue compounded at 16.2% annually, net income at 14.3%, and earnings per share has grown even faster at 18.8%. Earnings per share grew faster due to share buybacks. Though repurchases paused after 2022, shareholders still benefit from that lower share count today. Compared to peers, Ubiquiti's growth is solid. Fortinet led the group with nearly 60% annual earnings growth over the decade, while Cisco lagged behind, compounding earnings per share at just 2% annually. Looking ahead, analysts project Ubiquiti to grow earnings at 21% annually through 2027. Maintaining this pace while protecting profitability easily justifies a premium valuation. Which brings us to the biggest question in this entire thesis. If the business is growing, hyper-profitable and financially strong, why did the business drop 50%? Let's check whether the balance sheet gives the answer. The balance sheet proves this crash isn't a broken business. Ubiquiti holds roughly $100 million in cash against $300 million in total debt. That might not look flashy next to mega-cap tech giants, but the trajectory matters. In 2023, debt stood at $1.1 billion. Today it's down to $300 million. Management didn't just grow the business, they also aggressively de-risked it. The real story though is free cash flow. Over the past decade, free cash flow compounded at 14.1% annually, tracking net income perfectly. That's a hallmark of high-quality earnings. Earnings mean nothing without cash, and Ubiquiti consistently converts profits into cash. In 2025, they generated $600 million in free cash flow against $300 million in debt. That's a free cash flow to total debt ratio of 200%, far exceeding my 10% benchmark. This provides enormous flexibility, confirming the sell-off isn't due to fundamental decay. So far the picture is strong. A durable moat, elite return on invested capital, attractive growth, and a de-risked balance sheet. So why did the stock collapse 50%? Put simply, investors overpaid before the drop. Even after a 50% drop, Ubiquiti isn't a dirt cheap stock. It trades at a forward price to earnings of 31.8. Historically, it traded between 13 and 66 times forward earnings with a median of 27 times. That places today's multiple slightly above its historical average. Against peers, it sits right in the middle. Fortinet sits at 48.7 times forward earnings, while Cisco trades at 24.3 times. On PE alone, Ubiquiti looks fair, but PE ignores growth rate differences. Enter the price to earnings growth ratio, which factors in future growth. With expected long-term earnings growth accelerating to nearly 33%, Ubiquiti's PEG ratio sits at roughly 1. That beats peers easily. Cisco sits at 3.4 and Fortinet spikes to almost 4. Why is Fortinet's PEG ratio so high? Because while Fortinet compounded earnings at nearly 60% historically, analysts expect that growth to cool down to around 12% moving forward. Meanwhile, analysts expect Ubiquiti's growth to actually speed up, giving it one of the most attractive combinations of growth, profitability, and valuation in the sector. It's not a dirt cheap bargain, but after a 50% drop, the valuation is far more realistic. So did the market overreact? Yes, with one key distinction. The business didn't fall apart. Expectations simply reset after being priced for perfection. Here's the 5 key factor recap. Ubiquiti has a narrow moat through UniFi lock-in and a direct-to-community sales model. Elite 71.6% return on invested capital crushes competitors like Cisco and Fortinet. Double-digit compounding for over a decade with 20% plus forward earnings growth expected. Total debt slashed from $1.1 billion to $300 million, backed by $600 million in free cash flow. Ubiquiti is fairly priced on PE, but attractive on a PEG ratio just below 1. Putting it together, this isn't a broken business. It's a world-class company attached to a volatile stock. Founder Robert Pera owns 93% of shares, and Ubiquiti hosts no earnings calls and gives zero forward guidance. With no Wall Street handholding and a tiny 7% public float, even small sell orders can send the stock plunging. What do you think? Did the market overreact? Or is there some hidden risk? Drop a comment below, like and subscribe for more deep dives. See you in the next one.